Unlock the secrets of the market with Bookmap. It's time to master order flow trading.
Have you ever been just glued to your screen, watching the market completely break down? I mean, aggressive red candles just dropping like a rocket, everyone screaming, the bottom is falling out.
Right.
And then the price hits some, I don't know, seemingly arbitrary point and just violently reverses.
And it leaves all those momentum traders completely stranded.
Exactly. It looks like a classic failure, major crash. But sometimes that breakdown is, well, it's actually a trap, a highly choreographed institutional trap.
It is probably the single most defining market mechanic.
Yeah.
It's what separates the
Absorption
institutional player,
GCG6
the smart
COMEX sellers
money,
at 4,183.8.
from, the average retail participant.
So what we're seeing isn't real panic.
In those moments, what you're witnessing isn't genuine unmanaged chaos. It's the execution of a highly strategic trade. And it's designed for one thing, to accumulate massive volume at the perfect price.
And that's exactly why we're here today. We are
Absorption GCG6 COMEX buyers at 4,181.2.
All of it. We're diving straight into the raw underlying mechanics of the market. We are analyzing order flow.
Absorption GCG6 COMEX sellers at 4,182.2.
How smart money fills their enormous orders. A process
GCG6 COMEX sellers at 4,182.9.
One thing is liquidity.
Yeah, and we're going to be analyzing concepts drawn directly from some pretty advanced order flow analysis. We'll show how these large players use what are essentially structural weaknesses in the market to get what they want.
Okay.
And by the end of this deep dive, you're going to understand the crucial role of a single, really powerful term, absorption.
All right, let's unpack that institutional challenge first, because that's the foundation for this whole thing.
It is.
Why does a hedge fund with, say, $1 billion to put into a stock?
Yeah.
Why do they have to go through all this maneuvering? Why can't they just, click the buy button at the current price like everyone else?
The simple answer is scale. And their biggest enemy is something called slippage. Imagine an institution needs to buy, $1 billion worth of an asset. If they just hit the market with one massive market order, poof, they would instantly eat up every single available sell order on the books at the best price.
Okay.
Then they'd consume the next level and the next and so on.
So they're literally just climbing the ladder of price.
Exactly. And before they're even halfway through buying that $1 billion, the price might have jumped 1 to maybe even 5% against them.
Wow.
And that difference between the price they wanted to pay and the average price they actually paid, that's the slippage. On a $1 billion order, even a tiny fraction of a percent means millions in extra costs.
So they just can't afford to move the market against themselves just by trying to get in.
They can't. So their primary goal has to be executing that massive order passively. They need to find a place where they can buy huge amounts without sending the price to the moon.
Which means they need to find sellers. Lots of sellers. Preferably a lot of frustrated, aggressive sellers.
And this is where they start looking for their target zone. They do this using the volume profile.
Okay, the volume profile. It's that horizontal histogram you see on the side of a chart.
That's the one. It shows you exactly where trading volume has been concentrated at specific price levels.
And on that profile, you usually see two kinds of zones. These big, fat, high-volume nodes, and then these really thin, low-volume nodes. Why would they pick the quiet zone? That seems counterintuitive.
It does, but that's the whole subtlety of the strategy. A high-volume node or an HVN, that's a battleground.
Right.
It represents a price where the market agreed to do a ton of business. That means there are already strong opinions, established orders on both sides. If an institution tries to buy into an HVN, they just face instant heavy resistance. They get bogged down.
They don't want to fight. They want a supermarket clearance sale.
Precisely. So they look for the low volume node, the LVN. This is a thin area, a gap on the profile where very little trading has happened.
A structural weakness.
A structural weakness. And critically, it's an area where they anticipate that retail sentiment, and therefore liquidity, is going to flip into panic and fear really, really quickly if the price moves there aggressively.
That is the counterintuitive genius of it. They use these quiet gaps strategically. The tactic is to place absolutely massive limit buy orders.
Billions of dollars.
Just waiting patiently right inside these low volume pockets, usually just below what everyone else thinks is a support level.
They are setting the ultimate trap. They're putting out a huge passive order just to catch that inevitable wave of panic. They are intentionally baiting the price down to them.
Using the market's own structure to make sure they get the best possible price for the largest possible volume.
It sounds manipulative, but it's purely mechanical.
Okay, so that brings us to the liquidity hunt. Tell us what happens when the price is finally baited down into that LVN target zone.
Well, to the average retail trader who's just watching their charts, this looks like a total disaster unfolding in real time. You see these aggressive, fast-moving red candles, that's market sell orders, dropping rapidly, plunging right through weaker support and into that LVN zone. It screams, break down, sell now.
And what's the inevitable emotional reaction for traders who see that kind of sudden aggressive move down?
They panic. They do exactly what's expected. They see the price breaking a key moving average or a previous low, and they just start dumping their position.
Because they're afraid of bigger losses.
Afraid of greater unmanaged losses. And, crucially, all the automatic stop-loss orders that were logically placed just below that support level, they all start to fire.
Which just turns them into more aggressive sell market orders.
Exactly. It's a cascade.
So this tsunami of forced selling, the panic, the liquidations, the stop-loss cascade, that's the liquidity the institution was waiting for.
Absolutely. Their aggressive sell market orders are running straight into that massive, immovable wall of passive limit buy orders that the smart money placed at the LVN price. The institution isn't chasing the market.
The market is being delivered right to them.
Yeah.
On a silver platter.
On a silver platter. It's fascinating because this strategy completely bypasses the need for, complex forecasting or chasing indicators.
Right. They don't need to predict where the market is going. They just need to engineer the conditions so they can get the best price.
They're exploiting the inevitable emotional reaction. The plunge into that quiet zone turns retail traders into the perfect counterparty.
Traders who are selling at the absolute worst moment out of fear.
Allowing the institution to buy huge amounts without any slippage.
Which brings us to the technical climax of this whole thing, the powerful term we mentioned at the start, absorption. For everyone listening, just ask yourself this. What does it mean when you see aggressive market sell orders hitting the bid, red candles printing, but the price itself just stops moving down?
That sudden stop, that cessation of downward movement, even with high selling volume, that is the critical signature of absorption. This is where the sheer size of that institutional limit order really, really matters.
Okay, so walk us through the mechanics of that. What's actually happening in the order book?
Absorption is when those enormous resting limit orders from the smart money successfully soak up and neutralize all the incoming selling pressure.
So if 100,000 contracts are sold.
Right. If 100,000 contracts are suddenly sold via market orders, but the institution has a resting limit order for, say, 500,000 contracts at that exact price, well, that market order just gets eaten.
And you just see the volume tick up.
You see huge trading volume on the tape, which shows there's immense activity, but the price level itself doesn't budge. It can't go down because the institution is patiently taking every single contract that's offered to them.
That's why the analogy for this is so perfect. It's like throwing a tennis ball at a tank.
Exactly.
The sellers are firing all their ammo, but the tank is just sitting there, completely stationary.
The sellers literally exhaust their ammo. They've sold everything they wanted to, or they've just given up trying to push the price lower because nothing is happening.
And this phase must require a lot of patience to watch.
Oh, tremendous patience. It can take minutes, sometimes longer, for that entire limit order to get filled, depending on how much volume they need.
So this leads to a critical question. What happens if the sellers, the retail traders, just keep coming? What if the selling is real organic panic and not just engineered? Doesn't placing a huge limit order there expose the institution to the price just blowing right past them?
That is the risk. And that is why smart money doesn't just guess. They have risk protocols, for one, but more importantly, they rely on the confirmation step, which we're about to get to.
Okay.
If they see the price hit their LVN and the volume profile instantly shows this huge accumulation of sell volume without the price moving, they know it's working. If the selling is truly overwhelming, yes, they might pull that resting order to avoid a collapse, but usually these setups are placed where they're confident fear will provide the volume they need. They're trading mechanics, not fundamentals.
I see. So once that limit order is completely filled, once the institution has scooped up all the volume they needed at that great price, the entire market dynamic changes.
The path of least resistance just flips violently and instantly.
Because all the selling pressure is gone.
It's dried up. The pool of sellers is empty. So now Any relatively small amount of buying pressure can send the price soaring. There's just nothing in its way.
Boom, the reversal trigger.
The price rallies, and it rallies fast away from that low-volume node. It leaves that accumulation area behind and often heads directly toward the next major high-volume node on the volume profile.
And with the HVM?
Because that's where the next significant area of resistance and established selling interest is waiting. So this reversal, it is absolutely not random noise. It's the deliberate, successful completion of an institutional trade.
That makes the whole mechanism incredibly clear. We've gone through the problem slippage, the target, the LVN, the trapped limit orders, and the outcome absorption. So now the big question for our listener: how do we, as average participants, actually spot this without billion-dollar trading tools? What's the actionable playbook?
Well, we can leverage these principles of order flow even without the most expensive software. It just requires patience and using the right tools that expose this underlying structure. We call this the Big Limit Order Strategy Checklist.
Let's spend some real time on this checklist because this is the key takeaway.
Okay, so step 1, identification. You start by looking at the volume profile on your chart. You are hunting for that structural weakness, that gap or dip that is the low volume node.
That's your target zone.
That's your projected accumulation area. It should be a place where the price has previously moved through very quickly, leaving almost no volume behind.
And this is the prediction phase. But remember, the profile only tells you where trades were done.
Right.
You need to confirm where the big trades will be done.
Yes, you must verify that the big money is actually waiting there.
Which brings us to step 2.
Step 2. Confirmation. This is absolutely crucial. This is what separates good trading from just guessing. You have to use specific tools, a heat map or a depth of market tool, a DOM, to confirm that massive resting limit orders are physically sitting at that LVN price level.
If that wall of buyers isn't there, the strategy is off. It's invalid.
It's invalid.
For listeners who maybe don't use a heat map regularly, what should they be looking for? Describe what that wall of orders looks like.
On a heat map, you're looking for a thick, persistent, bright band. Maybe it's blue, maybe it's red, depending on your settings. But it's this huge stack of orders that looks like a physical wall running horizontally across the chart.
So it's not just a thin line.
No, not at all. It must look like a deep, committed cluster of hundreds, maybe thousands of contracts, shares, just waiting there passively. If that wall isn't there, the smart money isn't setting the trap.
And then comes what is probably the hardest part for most traders: the waiting and then the execution.
Step 3, execution. Patience is non-negotiable. You wait for the price to drop and drop aggressively. You want to see those fast red candles right into that confirmed accumulation area.
Okay.
Once it hits that massive order wall, you stop and you wait for the signal. You wait for absorption.
And what are the 2 signatures of absorption you have to see?
The first is high volume. You should see a huge surge in trading activity. That tells you the sellers are rushing in.
And the second?
The second, and the most important, is 0 further downward price movement. This is the tennis ball hitting the tank. If you see high volume but the price keeps falling, that's real panic, and the institutional order might not be big enough, or maybe they pulled it.
I think this is the exact spot where most traders panic and sell. They see the volume and the aggressive drop into the zone, and they just assume the momentum will continue. They abandon their plan right before the reversal.
That is the psychological gap the institution exploits. You have to wait for the selling pressure to exhaust itself. Do not front-run this. The absorption must be visually complete.
You wait until the sellers are totally depleted.
Step 4, the trigger. Only then do you enter your long position. After the aggressive selling dries up, after the price stabilizes, and you start to see the very first signs of buying, taking control, moving the price just slightly away from that LVN.
So you're entering right at the point where the institution has finished its business and the market dynamic is about to flip.
Violently upward.
If you follow those 4 steps, this strategy fundamentally changes how you view a market that looks like it's collapsing. It might just be the biggest sale of the day for the big players.
That's it, exactly. The core lesson here is understanding the difference between being the one who's exploited and being the one who exploits the flow.
Right.
When you see those aggressive red candles, your default reaction shifts from, oh no, panic, to, wait a minute, let me scrutinize this. Is this real fear? Or is this just smart money setting up their passive entry?
So to really distill the core lesson for you, the listener, the goal in order flow analysis is to move from being the liquidity that institutions exploit.
You know, the trader who's panic selling their contract right into that brick wall.
Trading with the liquidity, being the patient buyer who enters precisely after the institutional order has been successfully filled.
You're leveraging their need for volume. You're recognizing that their own operational necessity, that need to avoid slippage, creates a predictable pattern of reversal that you can visually confirm.
So think about that perspective shift for a moment. If institutions, with all their research and deep market understanding, see these aggressive price drops into low-volume nodes, not as a disaster, but as a strategic opportunity to buy huge volume at a great price. What does that imply about the very concept of market panic versus managed volatility? What assumption are you going to make the next time you see aggressive red candles plunging into a gap on the volume profile? Maybe that breakdown isn't a breakdown at all. Maybe it's just the door opening for the smart money to walk in and buy everything you're selling, something to mull over the next time you look at a chart.